The world is spending $2 trillion a year on military power. That's a higher level than during the Cold War, and most of that spending is being done by the United States that dedicates just under $8 trillion every year to that cause, and is in fact now actively involved in the conflict in the Middle East, sending aircraft carriers, weapons, and ammunitions to support Israel, despite Iran's defense minister warning that the US will be hit hard if no ceasefire in Gaza is implemented. In fact, we've already seen Iran-backed proxies attempt to attack US bases in the Middle East. If the US and Iran engage, it would lead to a military escalation in a region that is responsible for 30% of global oil production and 15% of natural gas production. These two sources of energy collectively make up 2/3 of our energy consumption. So an escalation of the conflict could have severe economic impacts. In fact, the World Bank just released a report saying that oil prices could rise by up to 75% in the event of an escalation of the conflict in the Middle East. That could take oil to around $145 per barrel, the highest level in history. In 1973, we saw such a rapid move up in oil prices in a very similar geopolitical context to today. In October of 1973, Egypt and Syria launched an attack on Israel on the holy day of Judaism, Yom Kippur, and triggering a conflict. The United States was also involved in sending military weapons, ammunitions, and tanks to support Israel, which led Arab oil-producing states to cut off the rest of the world from their oil. We saw the global supply of oil drop by around 7.5% as a result. Now, that may not sound like much, but oil prices tripled from $3 per barrel to $10 per barrel within just a few months as a result of this 7.5% loss. And it precipitated one of the deepest global economic downturns of the last 50 years. The US stock market began a 45% decline over the next year. The real gross domestic product of the United States, so the size of the economy, saw its biggest contraction in 20 years. And we saw the unemployment rate in the United States jump to 9% following the conflict. Now, imagine seeing the price of gas at the pump go from $3 per gallon to $9 per gallon over the next few months. That would take oil prices to levels we've never seen before in history, and you can imagine that would paralyze the global economy. That's precisely what happened during the Yom Kippur War in 1973. The US dollar lost around 20% of its purchasing power during the period of the conflict. This was an economic turmoil driven primarily by the escalation of the Middle Eastern conflict. Now the question is that something that could happen today? Now, while Israel and Palestine are not major oil players, Iran, on the other hand, is geographically located in a way that it can disrupt oil supply from major oil exporters. The Strait of Hormuz is a narrow passage approximately 21 miles wide, located between the Persian Gulf and the Gulf of Oman. It's one of the world's most critical choke points for the transportation of crude oil and sees 20% of the world's oil supply pass through it, coming from Saudi Arabia, Iraq, Kuwait, the UAE, and Qatar. Iran sits right on top of it, and it has already made threats to close or disrupt the Strait of Hormuz if America directly aids Israel in a war. That type of development would almost certainly reduce global oil supply by 7.5%. Now, rest assured, that's the worst case scenario. You could potentially see that if Hezbollah, the proxy force of Iran, launches an attack on Israel, you would likely see the US getting involved in such a conflict, risking the closure of the Strait of Hormuz. Of course, the US has strong military presence in the region and would also retaliate to this type of blockage or disruption of the strait, which would further destabilize the region and wouldn't do much good to bring oil back onto the market. But it's also not a guarantee that we would see oil prices triple like they did during the Yom Kippur War. In fact, the World Bank's worst case scenario is a jump of around 75%, so that's not even a doubling of oil prices. That's because the US today is the largest oil producer in the world. That means we're a lot less reliant on oil coming from Arab states compared to 50 years ago. So what is actually a plausible scenario here? According to that same report from the World Bank, even just a 3 to 5% loss of global oil supply could result in around a 30% rise in oil prices. That is their medium disruption scenario in the event of an escalation of the conflict. The problem with this is that 30% moves up in oil prices have almost always been followed by recessions, at least over the last 70 years. Higher oil prices push up the cost of production and transportation, which generally pushes the price of all consumer goods higher. Even food prices are influenced by fluctuations in oil's price, as a lot of the food that we eat is imported from abroad. A higher cost of oil leads to a higher cost of transportation, which is eventually reflected into the prices that you see at the supermarket. Fertilizers that also impact the price of food depend heavily on the price of natural gas, which would also be disrupted in the event of an escalation of the war. As you see the cost of essential goods like food become pricier, households cut back on spending, businesses see their revenue decline, and so they begin to lay people off, and that eventually leads the economy into a recession. The only time when an oil shock didn't trigger a recession was in 2022. Russia invaded Ukraine, and that immediately cut off the West from Russia's supply of oil, and Russia is the third largest producer of oil worldwide, accounting for around 12% of the global oil supply. It caused oil prices to rise by around 35% after the invasion. But as we all know, we didn't see a recession in 2022 following the Russian invasion of Ukraine, and that's because consumers had $2.5 trillion in excess savings from the fiscal stimulus that we saw during the pandemic. Today, those savings are gone, which does leave the economy more vulnerable to an oil shock in 2023 than it was last year. Fortunately, it doesn't seem like oil is heading in that direction right now. Oil prices are actually down 15% since September, which tells us that markets aren't too concerned about seeing a disruption of oil supply as a result of what's happening in the Middle East. What we have seen, however, since the conflict erupted is inflation expectations have been rising. That could be concerning to anyone who already feels that the rising cost of living has had an impact on their life. Because if we overlay the actual inflation rate, you can see it follows the inflation expectations by a few months. Inflation expectations bottomed in 2022. A few months before inflation bottomed, they topped a few months before inflation peaked in June, and they are now picking back up again since the conflict started. One possible explanation is that the market is anticipating that we're going to see disruptions in global trade. Around 12% of global trade goes through the Suez Canal. That's a canal that sits right next to Israel and Palestine. A destabilization of this region could disrupt the passage of billions of dollars worth of goods. That's what you call supply chain disruptions, and we saw a lot of that during the pandemic. This is the Global Supply Chain Pressure Index, and it measures how much supply chains are contributing to inflation. One lesson that we've learned from the pandemic is that supply chain disruptions can have devastating impacts on inflation and the cost of living. Now, again, you can rest assured because the Global Supply Chain Pressure Index is actually at a historically low level right now, so there doesn't seem to be any solid evidence that the conflict in the Middle East is causing any type of supply chain disruptions. So while it doesn't seem like the war in the Middle East is about to trigger a massive economic collapse, the United States is getting involved in the war and already spends around $877 billion a year on defense. This is where we could see some big economic impacts from the war as taxpayers struggle to pay the bill. This is 12% of the total government spending budget. Next to that, China spends around $250 billion a year, and this is what the next 9 countries with the most military spending in the world looks like. The US has more military spending than the next 10 countries combined. The wars in Iraq and Afghanistan both cost the US around $2 trillion. That's almost as much as the total GDP of Canada. Today, the US is once again getting involved in 2 significant wars. It has already spent around $113 billion on the war in Ukraine, and that doesn't include what the US could fund for the reconstruction and recovery after the war, which according to the IMF could amount to $400 billion in cost. For comparison, the total tax revenue of the US government in 2022 was $4.9 trillion. Rising US government debt is going to have massive massive repercussions on the economy and financial markets in the next decade. And for reasons that we explain to our clients at Game of Trades, we also happen to think it's going to benefit gold as an asset that has just bounced off some very important long-term price structures.